Okay, good morning, everyone. Artificial intelligence is reshaping the financial industry faster than any technology in a generation. Sorry, apologies, we're inside the wrong place. So the financial sector's total AI spend is predicted to triple to over $120 billion by 2028. That's almost threefold the level of last year. And yet attempting to assess the overall impact that AI will have on global financials remains highly subjective. So my name is Phil Richards, and I head the financials team across EMEA for Bloomberg Intelligence. My agenda today is threefold. First, I'll give a very quick overview of what Bloomberg Intelligence is. Second, I'll address the question before me today. And then third, I'll leave you hopefully with one or two thoughts to ponder over. So who are BI? Well, we're a fully fledged research house with over 500 analysts covering more than 2,000 companies, with plans to expand that to beyond 3,000 next year. We're, of course, being Bloomberg, we are global across the Americas, EMEA, and Asia, as well as sector research on equity and credit. We also cover markets and themes such as ABS, rates, volatility, FX, ESG, and many more. And when BI was set up about 17 years ago, one of the key goals was to bring the vast amounts of data on the Bloomberg terminal to life. And that very much remains the case today. And our research remains very much data-driven, with links taking you directly to that data. But we do much more than that. We host themes such as today with clients. We undertake a number of webinars, podcasts, moderate chat rooms, etc. We have also expanded much more into thematic and more deep dive reports, and also do a number of surveys. And that takes me on to the second part of my talk today. So I'm going to call briefly on a survey we undertook earlier this year to answer the question before me. So we undertook an anonymous survey of 93 chief information and technology officers of many of the largest banks globally, including some of those that are present today. And the findings of that survey are fourfold. First, those banks expect to achieve over $180 billion of profit upside over the next 3 to 5 years due to the rollout of AI, with 8 in 10 of those banks expecting to boost revenue by at least 5%. That comes at a cost. There's expected to be about 200,000 job losses as a result. But it's important to note that's just 3% of the combined workforce of those banks. Therefore, we see AI more about transforming rather than trimming headcount. And there are cost savings, scope for cost savings. That is seen as relatively modest, and I'll come back to why shortly. So if I dive deeper into some of the findings from that survey, management teams are bullish, as I mentioned earlier, with more than 80% expecting to boost revenue by 5% or more over the next 3 to 5 years, with just 1 in 20 expecting no impact on revenue, and none expected of revenue to decline as a result. 60% of respondents expect AI to drive a smaller workforce over the next 3 to 5 years, and that compares to just 24% expecting that to increase. But compare that to the following slide, which is on the costs overall, and the picture is much more mixed, with almost as many banks expecting costs to rise as expect to fall as a result of AI. And that reflects a huge investment spend needed as the banks build up to prepare for the AI rollout. We also assess the main challenges banks face from implementing AI. Lack of skilled personnel and integration with existing or legacy systems is coming out on top. We also look at the areas most likely to be impacted by AI, including risk management, fraud detection, and customer service. But before I wrap up on my agenda today, I'd like to leave you with a couple of thoughts to ponder over. I've mentioned a lot today about the huge revenue upside that these banks expect from AI. And what I'm showing here is a chart for the US banks over the last 40 years of revenue per employee. And I've adjusted the numbers for inflation over the period to restate all into 1984 prices. And what's clear is that over the 80s, 90s, and noughties, there was a steady rise in real revenue per employee. But since the great financial crisis of 07, 09, that path has been much more stable. And therefore, my question I would leave you with is, certainly for an individual bank, we can certainly see that huge revenue boost potential coming from AI. But for the financial sector overall, I think maybe a bit more challenging. And secondly, I had to go even further back, this time 90 years, back to the 1930s. And of course, that's a period of huge technological advances. The impact of the invent of the computer, electronic payments, introduction of PCs, the internet, and mobile banking, all impacting the financial sector. And yet, despite that, the cost-income ratio for the US banking system remained remarkably stable, within a very tight range of 56 to 70%. Now, of course, there's no denying the huge impact that AI will have on financial services. But when it comes to return on investments and banks' own profitability, will there really be this huge increase in revenues with costs remaining relatively stable, as people were predicting? And that would mean a breaking out of the overall 90-year trend. Of course, only time will tell, but thank you for that. And lastly, if I can just leave you with a very quick slide. I've talked today on banks and in the financial sector, but we are currently rolling out a much larger survey to over 600 senior executives, and this time across all sectors, so including pharma, autos, and telecoms, etc., and many more. And BI analysts are currently crunching through the data on that. So please stay tuned and hit BI Go on your terminal, as those results will be released soon. Many thanks.